Okay.
Okay, welcome guys to I think this is our week 2 episode 1, and like we earlier said, we're going to be discussing liquidity throughout this week. So without wasting much time, let's dive right in. So firstly, as a smart money trader, the idea of being able to enter the market with a certain level of precision is based off of traders being able to identify areas of liquidity. Now, one may ask, what is liquidity then? Liquidity, in simple terms, is money. Liquidity is money. So if we see that there's high liquidity in the market, meaning that there's high volume of money flowing into the market. If we say there's low liquidity, it means that there's low money in the market. So why is this term liquidity very important in trading Forex as a whole and trading smart money concept? It's because the banks are big institutions that have billions of dollars. You hear that they are the ones that control price movement, which relatively is the case because the more money in the market, the more the market moves. The market moves from one area of liquidity to another area of liquidity. So the question there now is that who has the most money to move the market? That's it. So that's why we define retail traders as traders with retail capital, and wholesale traders as traders with big capital. And wholesale traders are like institution banks, right? Now, don't get me wrong, we can still have small banks that are retail traders, like microfinance and all that, but we have real big institutions, hedge funds. That is what we call wholesale traders. So if you get the concept of liquidity and understand that every price movement, every move in the market is based off of one liquidity target to another liquidity target, then you will have an edge. So we're talking of liquidity. What are we implying? Now, it implies the ability of a currency pair to be bought and sold without significantly changing its exchange rate. So let me give you an hypothetical instance. So if we have a very big hedge fund or a bank, right, or a company that wants to convert $1 billion into euro. Now, if they just come now, let's go to if they come to the market now $1 billion and they want to like convert it and say, oh, let's look at how we can get the equivalent of $1 billion in euro. If they come and pump the money into the market like that, what happens? The market moves. You get it cuts the market to make gaps like this, significant gaps like this. And what happens? They lose money in the process. Yeah. So because they do not want to increase the price, they want to buy it at a cheap level. So they need that liquidity. You get, or in other words, they need sellers in the market. So if a company wants to convert $1 billion now to euro, if they do it when the liquidity is low, the market price will shoot up, right? And they don't want that. By doing that, they'll be buying at a higher level, right? So they need to be strategically putting the money in small bits, causing the market to move in certain ways that sellers are entering into the market and then they pumping. So the more they're having sellers getting into the market like this, they are pumping the money to come up. So the algorithm is strategically systemized in the way that it causes you to feel that the market may be going low at the time, whereas the overall direction may be heading upwards. I don't know if I'm clear up to this extent. Sammy, I don't know if I'm clear.
Yes, you are.
Okay. All right, so let's go deeper now. So we said that a currency pair is considered to have a high level of liquidity, right? When you can easily buy or sell it. Now, when you see price moving at a particular range and your ability to be able to buy and sell it easily means that there's good liquidity at the market. And that's what the banks are after, okay? So the key point to note here is that every trade is a transaction between a buyer and a seller. So the more money in the market makes it easier for trades for those who have bigger money to play with. So if I have $1 billion in the market as a big bank, right? The more I also see that a lump sum of people have been able to have like that equivalent in the market, then that's good, because then it makes it easier for me to buy and sell as well. But in a market where I want to pump in $1 billion and I'm only seeing that there's low liquidity of maybe like $100 million, then it doesn't serve me well. So I'm strategically going to be trading with those people's money. Maybe if they have 100 million, I'll be looking to be play with 200 million. You get, so that then they are pumping in more monies there to sell. So as they keep on pumping money, I'll get enough liquidity in that area to pump in my $1 billion to make the market move. So I think this explanation gives you a proper insight to what liquidity is as a concept in Forex, right? So now, haven't talked about liquidity now. Next question is, how then do we spot these areas of liquidity in the market? And how then do we know how to trade off of liquidity? Or is liquidity a thing that we just see in the market and say, oh, we are buying and selling? So now let's look at the chart. Firstly, let's draw. Let's draw. Let me just go to, let me go back to where I wrote where's liquidity. Okay, so now, what are the types of liquidity we're looking at? First, we have swing points. What is this? Okay, sorry about that. Okay. Now, this is our first type of I'm sure you are familiar with this. What is this? Market structure. A series of what? Higher highs, higher lows, higher highs, higher lows, higher highs, higher lows. But if you look at this, what happens here? We have a break of structure, and what? This is our expectational order flow right here, assuming that we're assuming here that the price is going to break structure. So that's our expectational order flow, right? So from this trade, we can see these swing points here, 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 here. Now it's interesting to know that liquidity lies above these points. Now, so now if we have a bullish market, each swing point in the market is considered a liquidity zone. So we have liquidity resting here. We have liquidity resting here. We have liquidity resting here, and we have liquidity resting here. That's why you see that each time price goes up, what happens? There's a pullback or a retracement, right? And what? It targets this liquidity to take out this area. So what happens? You break this structure, and then it has cleared out, and this liquidity has been taken. So that brings me to also explain that each time the price sweeps along the line of an area of liquidity, that liquidity seems to have been taken. You get? Doesn't mean that other things cannot also act as a confluence to referring back to those areas of liquidity. But at the interim, when you're trading, this price. This is my, as at the time when this market may have been somewhere, hold on, when this market may have been somewhere around here. So this would have been a liquidity to target. I may have taken out internal liquidity resting on this range, right? So at the time when price has come here, maybe respected and an order block seated somewhere around here, a demand zone. So this would have been my liquidity what to target. So that is why we have that here. Are we understanding this so far?
Yes, clearly.
Exactly. So swing points, our first type of liquidity is what we call them swing points. That's why I can't edit this. Okay, so let's call them swing points liquidity. So what other kind of liquidity do we see in the market? Let's get my line. Next kind of liquidity that we see, we'll see the market do something like this. This. I'm making this complex for a reason. Now we can see now that when we're trading here, we'll have noticed that price kept tapping into this area. Because I'm going to bring out two liquidities here at once. So, and then we see this area here being respected too. Then what else do we see? We see this area is also being respected. We can also see this area being respected. Now, though this liquidity will come in two ways, right? But I want you to first get this one as it is. This is called our resistance and support liquidity. So this is resistance and support liquidity, meaning that we have liquidity resting on point of resistance and what support levels. Normally, as retail traders, when we see that there's a double top here, like a double bottom, what happens? You see the market is going to go upwards. If you see that there's a double top here, they'll say what happened, the market is going to go downwards. So it's interesting to know that liquidity rests above these areas of resistance and support, what retail will call resistance and support levels, right? Then also an hybrid of this one is also this liquidity, where we have the market trading like in a particular direction, and they will see something like this. Right, so what do we have here? We have, let's put this like this. Oh, let's not take it up. What do we have here now? So we have these three. It's also a resistance and support. Remember I said this is also an hybrid, because it's not every time. A resistance support level most times is where the price has kept on testing a particular level over a period of time, right? But they are short trades that you can just see something happening like this. So this now we call them double tops. So this is the one that resistance level is an area where you can see price can also come here like this. Now in this case, you can see price may so come here, do like this, do like this. Then another time come here and do what? Bounce off of here again, come down. Do you get my point? So this is an area of resistance because the price has over a period of time respected this area, this zone, right? And maybe here as well. But for short time trades, something like this, where maybe you are just heading from this high, from this low to this high, and then price does one this way, on this high to this low, you see something like price making a price doing something like this along the way. From here, maybe it came here, did like this, then it stopped here again, and then you say, oh, it's a double top, and then it came all the way down. You get, so this double top now, it's also a kind of liquidity. We have what? We have liquidity resting above those areas. So have liquidity resting here, calling it a buy side liquidity. We have buy side liquidity resting here. Also, even at the bottom, we have liquidity resting here. Okay. So those are three kinds of liquidity. Then, what other kind of liquidity do we have? Which brings us to, okay, this is our, call this double top, double bottom. Double or triple top or bottom. Okay. Then what kind of liquidity again can we see? We have, now remember we treated on the other, when we're treating other blocks, we talked of fair value gaps. So that's also a form of liquidity. So we see the market does something like this. Let's say this is a bearish candle we're making here. So what happens? See, this is a bearish candle. We just turn that red. Good. So, okay, let's put our wick. Let's say we have one small wick here. And then we'll have another wick here. So we see this level of this gap here in the market, right? From this point to this point, which is our fair value gap. So more often than not, you see that when price or when banks pump in this money, you see that it leaves this gap, which we call a fair value gap. So it is an area that is not mitigated. So we need price at a certain time to come and fill it or mitigate it. Why? Because we need these two candles to align. That is the low of this high of this candle and the high of this candle right here. So what you may see in the future, well, not all the time, because you know that the bank will always get the prices at the level that they want it, right? But they will always be able to at least fill it to a certain level where they can take their loss and then trade for that to, you know, deal with retail traders. So you can see price coming down here, does something like this, does something like this, does something like this, does something like this, then come into this area here, right, to fill this level of inefficiency. And what happens? Continues down. So this is a downtrend, right? But price now had to come back up to come and take and fill this level before continuing downwards. So this is also a kind of liquidity. Most times people may not treat it as liquidity itself, but it is a kind of liquidity. Why? Because it is an area. For me, my definition of liquidity also stands from the point that any area that financial institutions are trying to target for price to be, for them to be able to continue in their actual direction, is an area of liquidity. So even though that there's an inefficiency from the amount of volume of money that flowed into the market causing this gap, it is also an area where they may want to come and fill their orders. Because at the time when this gap has come, you see that maybe we now have something like this here. Let me give you an example now. So we may now have something like this here, right? And then you see that this candle will now come down. So what happens? So when we see this inefficiency and then price came here and did what? Double top. Let's look at from the lens of a retail trader. What would this be now? Double top, right? So what is that? Liquidity. So for a retail trader now who sees it, even for smart money traders who sees it as a double top and then maybe a valid OB here, then they may open their sell around here now. And what happens? Let's put this here. They may open their sell around here. Their stop loss will be resting. Let's zoom in down. Their stop loss will be resting where? They open a sell from here. Their stop loss will be where? Here. And their TP will be maybe this low, right? Well, what happens? What happens? So immediately they get into it, the trade start going down, and what happens? It takes them out to go and fill this area. Does that make any sense?
Not exactly.
No,
it doesn't.
Okay. I'll explain it better for you. Good. Now, do you understand the concept of fair value gaps?
No, that's all you mean now. You said
yes.
If you get to a fair value gap, then to go straight down on the sale.
Yes. No, you know what price? You know what I'm explaining to you here? I'm explaining to you here now is what price does, or what you can likely see in a real market condition, not our paper drawing. Now, in real in a real market condition, right? We are looking at it from two angles. Remember, I told you that the bank's aim is to always target areas of liquidity, right? And that's what we as smart money want to trade. Smart money trades with the banks. We don't trade outside what the bank is doing. We're trying to be the small leech that is holding on to the like the bacteria holding on to the body of something. Just that tiny is insignificant bacteria, but at the end of the day, we are moving with it. So not being retail traders trying to use logic. Logic now is this. We see things like, that's why if you notice, everything that we have labeled here as liquidity areas are retail like they are retail concepts. You get, we have resistance and support. You know, when we started trading Forex, we trade off of resistance and support levels. When it comes to resistance and you say, oh, it's going to hold, we start selling, right? So if you had held this support level, this resistance level here, maybe you sold, you would have been right that day. You get, another day you say, oh, it's going to hold again, and then it stops you out. And more often than not, it stops us out, right? Also, if we're trading just basic swing point that, oh, it has gone up, it has come down, meaning that we can buy from here to go here. That's wrong, because this is a liquidity area. Or maybe, sorry, we said we sold here. Let's say double top, we sold and we're going down. Meanwhile, liquidity is resting above every swing point. So the fact that this is a swing point, it already marks it as an area to target. Same thing with the concept of double tops and double bottoms. So with fair value gaps, where we have this inefficiency in the market, and then we see price now come and do something like this, making, what is this? This is a double top. You get? Now, this may actually induce a retail trader to actually say, oh, I don't think that the price is going to go back up here. Let's just enter a sell from here. And this is the sell. So when they open the sell, it starts going down, right? But what happens? It takes them out and then they're wondering that, but this was a double top. Does that make sense now?
Yes.
Yes. But what I'm saying now, that's for retail traders. That's through the eyes of a retail trader. Now, what I'm saying is looking at it from a financial institution point of view. They have this fair value gap here, however, how wide or how thin. And they feel that they need to come back and fill it. They need to come back and mitigate this unmitigated zone, right? They need to fill the inefficiency here by bringing price to test, even if it's just this week, or come and touch this, which will be our order block. And they fill it, and then they push price downwards. Now, originally, the price was always going down. But what happened? People went out there thinking the market was going to like break out this low. Got stopped out. This is liquidity now. So the bank now has gotten this enough capital or this enough liquidity to be able to send price, fill in this area, and push price down. Don't worry, we'll get there. We'll get there. That's another class entirely. Okay. So what now I just want you to understand now is understanding that fair value gap is liquidity. This class, the takeaway is this: understand that liquidity is money. Liquidity areas or zones where large orders of sales and buys are being placed, right? The bank always look for how to fill this liquidity or to take this liquidity in a bit to pump money into the system. They can't pump in money into the system all at once because it's going to cause gaps in the market that will cause inefficiencies and hence making them lose. Do you understand? So what we are labeling now are the types of these liquidities. These are the types of areas where we can spot these liquidities in the market. So we've talked about swing points, whereby the price is targeting the highs or the swing points of every market structure. We've talked of resistance and support, where we have market testing a certain region over time, building liquidity on top of those zones. Now, it's always important to know liquidity rests above those zones or below these zones, right? So we have resistance and support. We have double or triple top, where markets consecutively making rejecting over a place like this. 1, 2, 3. Liquidity is resting here, right? Then we have fair value gaps.
Yeah, when I was asking, when you talked of liquidity, it's sweeping liquidity at support and resistance. So I was now asking, does it mean if we are on an uptrend now, would when it sweeps liquidity, when it goes to the fair value gap, it will now take a buy?
No.
Why did it sell here?
Why did it sell here, right?
Yes.
Good. It sold here because don't forget about just looking at this as an example, right? But for us to be able to determine why it actually sold here, the first thing is to actually look at what the external market structure was doing. So if externally we were actually on a sell trend like this, right? Oh, sorry. If externally we're on a bearish, we're going bearish, right? So this fair value gap, this whole thing we're seeing here, will be something playing out around here. Do you get my point? We'll see this fair value gap happening somewhere around here, causing this zone, this supply zone will be here. Right? Then we have this market. We have this market here, right? Coming to do something like this. As at the time where price left this inefficiency here, right? We'll see that price now came, did this, now caused a double top. 1, 2, came back here. I'm going to arrange it very well. Then aligns with this one. So this will be this ideally will now be here. Sorry, my drawing is funny. You get now. This one now. This is the supply zone, right? Now we are in a bearish order flow, right? When the market came here, it left this fair value gap here. It broke this structure, right? Got a break of structure here to the downside. Then our expectational order flow is for price to actually come all the way up here and continue down. But retail traders now still having the same kind of mindset about the expectational order flow, right? They see that the market now came, made a double top, and started giving indications for it to go down. Do you understand? Therefore, they now put this their trade here. Do you get me? So they are not wrong about the expectational order flow, but what they are not failing to see is that there's no area of liquidity. Do you get? There's no area of liquidity that they are looking to, that they are forecasting that the bank is going to take for them to be able to go into the trade. Whereas they are the one that are the liquidity. You get? So banks now have seen them as the liquidity to take. So you now the liquidity, because whoever opens the trade here based on this double top is liquidity. You have given the bank liquidity, and so they will take your money. You get? So instead, a smart money concept guy will be the one that will know that this area is an area of liquidity. So they will not be looking for how to place their trade around areas of liquidity. You want to put your trade either above or below areas of liquidity, depending on what you are trading. So this is the area now that bank will be looking to take out as liquidity, and also fill this inefficiency here, which is also like a hybrid kind of liquidity, and then continue downwards. Do you understand now? If you don't understand now, don't worry. The liquidity is going to be, it's not, you can't grasp it once. We are going to take liquidity for 3 days. The important thing is for you to have the concept. Like I told you before, don't try to rush your understanding. We'll stop somewhere around here now. What you're going to do now is to go back and then understand, rewatch this video and get to understand these types of liquidity. Your assignment will be to go on the chart and spot these areas of liquidity on the chart. All right, so tomorrow we are going to be talking about inducement and how to spot liquidity. That's the liquidity we just talked about, how I can look for them on our chart. Okay, so that'll be all for our class today, and take it easy and see you tomorrow. Thanks.